One of the biggest mistakes that people make with taxes is getting a refund.
Yeah.
When you get a refund, you've allowed the government to hold on to your money for a year interest-free.
And you earned nothing on it, and you gave them too much.
That's exactly right.
All because you want that thrill for 5 seconds if you got a check, right?
That's right. So
That's
I
right.
want people to get their money sooner to be able to use it. So, Rachel, let me show you the first example.
All right.
So the average refund is around $2,869. So instead of letting the government hold on to that money, if you were to make adjustments to your W-4, you could get $239 extra a month. And so what you could do is if you got that, you could start to invest it. Now, what I'm showing you here is that $239, if it were invested, average Roth IRA is around 7 to 10%. But if you were to invest that $239 each and every month, what you're noticing is the green. The green sand is the return on your investment.
Right.
And so instead of you, and Rachel,
Just
if you will.
a little bit of
Yep.
extra money a month if you just made a small
That
adjustment.
accumulates over time.
It will
To your
accumulate.
W-4.
That's right.
Yes.
The green is the return on that investment. This is a positive for us. But if you let the government hold on to it and you get it back at the end of the year, look at what you get. You get all of your money back, but you don't get any of the interest.
See,
So-
that's how much cash you would have if you let
That's
yourself
right.
be the boss of your money. That's what you're going to be left with if you let the government be the boss of your money.
You just have your money back. Remember, it's your money. It's not a bonus. You've worked hard for this money. So if you are in this category and you're not sure, go talk to your HR director or your tax professional. Adjust your W-4. You can get more money coming to you sooner, and you can attack debt, save, or this example, invest.
So this is
That's what it would have been
Yes.
had you not.
working for your money versus your money working for you.
Nate, I like that. That's
Nate,
exactly right.
well done.
It is. 3 filing statuses. You've got single, you've got filing head of household, and then you got married filing jointly. So let's take a look at the standard deductions you can take if you were single. Average person, average income in America is around $50,000.
Right.
So let's say they took the standard deduction of single of $12,200, head of household $18,350, or married filing jointly of $24,400. Now, people don't take into account life changes.
Right.
People get married, you have kids,
Yep.
you have different things that happen.
Yep.
But people will just pick these randomly without understanding. So the average return of someone making $50,000, taking the standard deductions of
what we were
$7,200
just talking
is the
about. Yep, the
$2,869 we were
28.
just looking
Yep.
at. But take a look. Under head of household, it would be $3,690. Now, we're going to talk about head of household in a minute because this is an error people are making. But if they were to file the taxes together,
Right.
married filing jointly, you can see the return would be $4,527. It makes a difference in how you file. A lot of people are just picking something randomly.
Right.
Now, let's talk about head of household. This one is a big misnomer. Most people think if they're making money in the home, that you're head of household. Not so true. According to the IRS, to file head of household, you have to be single, you have to be taking care of a dependent under the age of 19
Right.
Oh,
or
wow.
under the age of 24 if they're a full-time student.
Right.
But get this, your spouse is never considered your dependent. Okay, so a lot of people will just pick this randomly, and you can end up getting in trouble by not paying enough or getting too much back. You'll get
Yeah.
penalized.
I see.
But you can also be head of household if you have a relative living with you when you're taking care of them.
Right.
No one else is claiming them on their taxes, and they can't make more than $4,200 a year.
Under your roof. Yeah.
Under your roof.
Yep.
So it's a lot
So
of
if you had
things.
an elderly family member living you, that would still qualify as long as they earned under that.
Under $4,200 a year,
Yeah.
you could claim head of household as long as no one
Wow.
else is claiming them. The other thing for head of household is you have to be paying up to half of the expenses for the upkeep of a home.
Well,
So-
head of household.
Right.
That
Correct.
part I would guess.
Yes.
There's a lot of details in there I could see people getting confused about or
Yes.
getting wrong.
Yes. Now, a couple of other things. You all know we've got a $1.6 trillion student loan problem right now.
Oh.
$1.6 trillion.
Yeah.
It's backbreaking for so many people because
really
they don't
is.
understand all they're paying off with their minimums is interest.
That's exactly
Yeah.
right. But here's the thing. With taxes, you can actually deduct the interest without itemizing. Okay, up to $2,500 in interest. Now, parents, if your student took out a student loan and is paying the payment, you can't deduct their interest.
No, of
Right.
course
Right?
not. It
You
has
can't.
to
But a
go
lot of
to your
people,
child.
it has
Right.
to be for them. But here's another one, Rachel and Nate. Also, medical expenses can be deducted. So your income has got to be over 7.5%
Okay.
of your income, those medical expenses.
Right.
But it's things that your health insurance didn't pay for or your HSA didn't pay
Really?
for. So dental, a surgery. This is
Dental
something
can knock you out.
big time.
So
One
few plans
braces
even
visit.
have, exactly.
Yes, absolutely.
So few plans even have dental.
Yes.
Right.
So the big thing is taxes, there are a lot of nuances.
Right.
The main thing is don't do it alone. Taxes are like us as individuals. It's all unique. So there's no cookie cutter approach. You need to talk to a professional to give you the right guidance.